Good evening, everyone. Real quick, please take a moment and read the disclaimer. I am not a financial advisor. I have no certifications. I just do a lot of research. This should only be used for entertainment and educational purposes. Please take everything I say with a grain of salt. And with that being said, many of you are correct. It is a chocolate milk type of day. Absolutely delicious. Absolutely delicious. All right. So I didn't get out of bed till about 10:30 this morning. And then next thing you know, now I took the day off. Next thing you know, the market started tumbling after NVDA absolutely smoked earnings last night. So it was an ugly day. The Bears certainly won this round. There's no question about it. S&P went down 1.6% roughly. The Dow fell almost 1%. NASDAQ went down 2.2%. And got some data that wasn't really bullish. So while the September jobs report had non-farm payrolls at 119,000, which was more than double the 50,000 jobs that economists were expecting, unemployment moved the wrong way and it ticked up to 4.4%, which is the highest in almost 4 years. Wage growth stayed solid, but there were some downward revisions. July and August payrolls were revised down for a combined 33,000 jobs, and weekly jobless claims fell to 220,000 last week, which may look healthy on the surface, but continuing claims climbed to about 1.97 million, which is the highest since 2021. I think everybody who watches the channel and watches some of the other guys whose shows I go on know that I really am worried about the job market. And I don't think that we're really feeling the full dynamics of the recent layoffs from the very big companies. I think we're going to get more. And I really want to see the Fed cut rates. I mean, this is getting crazy. And I think that the productivity gains from AI and robotics over the next several years will be at the expense of jobs. And our elected officials need to figure something out. But that being said, the AI bubble narrative, which should have been dismantled last night, and I am not even going to bring any of the posts up from X. We're not even going to give them the time of day. I think everybody needs to take something into consideration. You're either a long-term investor or you're not. You're a day trader, short-term money, or a long-term investor. Now, as I've said before, this is going to be a little bit of tough love. There are parts of the market which are very expensive, in my opinion. I'm going to read out some names and show you why some people aren't freaking out and some people are. And I'm not saying that all of these names are overvalued, but SPY, which is the de facto S&P 500 index ETF, is only down 5.4% since the turn. It hit $689, closed today at $652. It's fallen $37, 5.39%. Now, Hood, since its recent highs, is down 31%. Palantir is down 25%. Rocket Lab is down 47%. Oklo is down 55%. CoreWeave is down 63%. Nebius is down 40%. So a lot of names that are very popular in the chat whenever I look at things are getting sold off. Now, I didn't look at big tech. We know big tech got hit today, and I'm going to go into NVIDIA. I'm going to go into some other things about why I think this is an opportunity for certain companies and for markets overall. But If you had a deep concentration into a lot of the high flyers and didn't protect profits, you're feeling a lot of pain today. And if you have a very concentrated portfolio of only these names, or they make up a large amount of your portfolio, it may seem like the world is falling. But the reality is the S&P pulled back less than 6% since all-time highs. So a lot of people are sitting there and not feeling it the way that others are. And this is why I always say that I'm very diversified. I certainly feel it on days like today because I'm overweight tech, but my capital is spread around to a lot of things, and I have a good percentage in the S&P as well as other index funds. And once again, markets do not go straight up, and nobody should expect companies or the market to go straight up. There are always retracements. In every market, if it's healthy, you're going to see a retracement. And one of the things that I really get crazy about when it comes to the bear thesis around AI is every single market time frame. You want to go year by year, you want to go every 5 years. We can pick apart areas that heated up way too much and ended up falling. But that doesn't mean that there was a bubble. And when I follow the money, the bear case that is being put out there just does not make sense. And now I spent the day doing a lot of research. I wrote an article on NVDA, which should be out tomorrow. I have not watched CNBC a lot today. So I pulled up a couple of clips that I want to watch and react to them. But I also made 7 tabs on a spreadsheet that I believe will show why the bear case does not make a whole lot of sense. And we also need to stop for some coffee. I gotta tell you, getting out of bed at 10:30 was freaking amazing. Really was. All right. So we're going to share this the normal way. I think everybody knows what NVIDIA did, so I'll refrain from going through how amazing of a quarter it was, except for saying that a company that does 63% year over year growth from 35 to 57 billion in revenue, that's insanity. And if you believe the numbers, it's the best quarter I've ever seen in my life. And it should be celebrated, and NVIDIA is trading at a multiple that does not make sense right now. And their largest clients are Alphabet, Microsoft, Amazon, and Meta. And we're going to go through a bunch of stuff right now. I believe I shared this correctly to show all the different tabs as I go through. Okay, it does. Okay, so we'll run through this really quick, and then I want to watch some of the stuff that I have up here. I didn't get to see what Dan Ives said, although pretty sure I know what he's going to say. Didn't get to see what Tom Lee said, but there's someone called Tim Seymour who I happen to like a lot, and I'm interested in what he said. So let's go through this. So right now, the combination, we're just going to call them the 4 horsemen because they are the ones that are spending the most on CapEx, okay? After the 4 horsemen, I like the way that sounds, the 4 horsemen. So in the trailing 12 months, they've generated $1.5 trillion in revenue. They've generated $549.7 billion in EBITDA. Their cash from operations was $536 billion. These numbers are insane when you put the 4 of them together. And after their allocation of CapEx, their free cash flow in the trailing 12 is over $200 billion. Now, the combination of these 4 companies in 2024, which is this chart here, and I have it broken out color-coded on a year-over-year basis. This is the TTM, and this is expected. I don't know. I actually didn't catch it. I didn't do it down there. Apologize. So the total spend in 2024 is 217 billion. In the trailing 12, they've allocated 329 billion toward capex. They've increased their capex spend by almost 52% year over year. Now, Microsoft does not report on a calendar year. Their fiscal year ends in traditional Q2. So that is why the capex spend in 2025 expected versus the TTM is different, because after their Q4, they did 64.5 billion. But after listening to the earnings calls, these companies are expected to do 354 billion in capex this year, which is an additional 137 billion or 63% more year over year. This is not being fueled by venture debt. It's just not. Now, a lot of people on the bear side who clearly won today, but just one day. You got to think about this as battles within a war. Your entire investing career is a long-term war against the market. And this is just one battle out of many of them. And every day is a different battle. But when I look at what happened with the capex allocation versus what Apple has done, it is pretty wild to see that Apple has completely underinvested compared to these four companies. And unfortunately, there's one other thing that I wanted to put on here, and I don't believe I did. So just give me a sec. Let me go through everything. I did. Here we go. All right. So we can see by this graphic, Apple has clearly underinvested in CapEx, as they typically do. They do not have a business-facing cloud, and they are very far behind on AI. The other four, some people would say, are egregiously spending on CapEx. Well, here's the actual breakdown. Apple, on an annualized revenue basis, okay, from the 2021 fiscal year to the TTM, so over the last 4 years, they've grown their revenue by 13.76%. Their cash from operations has only grown by 7.16%. I'm sorry, I'm looking at StreamYard right now and realizing that you guys can barely see this. So as I'm reading off the spreadsheet, I believe that is better. So Microsoft, Alphabet, Meta, and Amazon, who we all know has allocated a tremendous amount to CapEx, in the same period, Microsoft has increased its revenue by over 67%. And when you look at their cash from operations, it's increased by 65% compared to Apple's 7%. And Apple was the only one that was doing more than 100 billion of cash from operations in 2021. Now, Microsoft, Alphabet, and Amazon are all putting up more cash from operations than Apple. Meta's right on their heels and could surpass them after the next quarter. We're also seeing tremendous growth in cash from operations over the past 4 years from the other four. And this is a direct correlation to the CapEx allocation. So investing in themselves has made their cash from operations and profitability explode. So I take what the bears say with a very big grain of salt, because when I actually follow the money, it looks very enticing to invest in the AI revolution in cloud computing, considering the amount of growth there is. Now, I think before we get into the valuation, I want to talk about debt real quick. These companies are not funding, and I should probably look at StreamYard also to make sure that everybody can see this on screen. So the four horsemen are not funding this from their balance sheet. They're not funding this from debt. I mean, they have positive net liquidity positions when you look at their cash and short-term investments, their long-term investments, and then how much long-term debt they have on the balance sheet. I mean, Alphabet still has a net liquidity of over 140 billion. Microsoft has over 76 billion. Amazon has over 56 billion. Meta has over 40 billion. And then they're all still producing free cash flow. And at any point, they can just go into maintenance mode and then monetize all the capital they've deployed into CapEx and watch cash from operations explode. And that will take the free cash flow up. So once again, I take it all with a grain of salt. Now, before we go into valuation, I want to discuss margins. Okay. And I know I talk about Walmart and Costco a lot, and I saw an X post about this. So I purposely built this out. I did on purpose. I'm sorry, but my mind is not changing. Costco has an operating margin of less than 4%, an EBITDA and a cash from operations margin of less than 5%, and a free cash flow and net income margin of less than 3%. And people want to get excited about Costco doing $8 billion in net income. Costco's a phenomenal company. It's not in the same realm as the Four Horsemen by any stretch of the imagination. It is crazy that people are willing to pay almost 50 times for their profitability with those margins or for the amount of net income they produce. It's crazy. I mean, these are four of the best companies in the world. And their CEOs are telling us we need more compute. We need to invest for the future. We cannot keep up with the demand. The backlog from just Alphabet, Microsoft, and Amazon on cloud is $755 billion. That's the backlog from the most recent earnings calls. They're going to keep spending. They've all said that they're going to increase spending next year. And these companies have tremendous operating margins, and they're trading at good valuations. Now, as you know, I show this chart off or table off a lot. Over the past day, NVDA started yesterday at $8.09 a forward EPS. It went up to like 870 at the end of last night, and now it's at 943. And I believe it's 32 analysts that are making up this average. NVIDIA is trading at less than 20 times 2027 earnings. Let me say that again. Less than 20 times 2027 earnings. Meta is trading at less than 18 times. Once again, this does not look like an expensive market to me. It looks like a market where a bunch of companies got way out of control with the valuation. They're getting hammered, and a narrative is forming, and people are getting scared. I can't prove any of this, but I do believe a lot of algos and stop losses got triggered today. And look, if people are moving out on their own, fine. But I bet you not a lot of people were looking at the market when you think about how many actual market participants there are, because a lot of people were at work today. People are not selling their S&P 500 index funds. It's just today is, to me, a long-term opportunity. And if the market keeps going down for a while, it'll be an even bigger opportunity for long-term investors. Every time this happens, it always corrects itself. Maybe it takes a little bit more time. Maybe the Fed's an overhang. Maybe we got to get through the Fed meeting. And I do think the Fed is an overhang. But at the same time, Costco trading at 37 times forward earnings and Walmart trading at 33 times forward earnings on an idea that people are still going to have to buy food is ridiculous to me. Because compared to Amazon at 23 times, that does not make sense. Take all big tech out of it, except for Amazon. Walmart and Costco do not have AWS, and Amazon is more profitable, better margins, and is trading at a discounted valuation compared to them with more forward growth. Everybody always used to say, you don't understand, you're a value investor, you pay up for growth, pay up for growth. Well, I'm not seeing that you pay up for growth. I think that There's companies that are expensive. And right now, the Mag 7 X Tesla, because I think Tesla's valuation is extreme. I think the Mag 7 is very attractive X Tesla for long-term investors. I do not think this is an expensive market for an S&P index fund. And when I look at where Costco is and Walmart versus even Apple, I mean, Apple's at less than 30 times. I mean, why would you pay? I mean, I'd rather buy Apple here than Costco or Walmart. That's just me. And I'm going to stop sharing. And there's two charts on macro trends that I want to bring up. And then we'll go into some videos and then I'll interact with the chat. That was my rant on the bears are wrong, the very toned down version. I am going to put a very lengthy post out there. But at the same time, let's see. Chart I really want to show is the EPS. All right, so this is one of them. Just getting the other one up. And it just popped into my head. That's why I am not prepared with these two charts I wanted to show. Is the other one in the economy section? Just give me one sec. No, I'm not sure where the other one is, so I'm just going to share the screen on this one. So this is the S&P 500 earnings over a 90-year historical chart. Look at the S&P earnings. Absolutely sky high since 2000. I mean, people are talking about a bubble and trying to compare it to the dot-com era. EPS in July 2000 was 53.70 for the S&P. You're at 225 right now. Yeah, 225. And that's not even taking into consideration the most recent quarter. These companies are becoming more and more profitable. I don't think that this is an expensive market. There is one other chart that really shows it well. And I can't believe that I can't find it. I was looking at it before. Bear with me one sec, everyone. Oh, wow. We will, we're going to go into some videos. Let me share the other screen. So I want to see what everybody on CNBC is saying. So let's start with Ives. Pretty sure we know what he's going to say, but let's see. I want to see if I agree with him. I did it again, everyone. Rookie mistake. Did not share volume. All right, we shared volume this time.
Earnings season where these companies pretty much did everything they were expected to do and more. Recommitting to the AI trade, essentially saying that they're still enthusiastic about it. Why is the market in general not really giving them credit for it?
Look, first, I think that was a masterpiece quarter, right? And I think any worries about the AI bubble thrown out the window in terms of fundamentally, when you heard from Godfather of AI, NVDA, look, I think it speaks, and you've talked about a lot on the show, like worries about circular financing, like where this is going to go. Can the data centers going to get built? Is there capacity issues? Look, I just continue to view when you put the pieces together of the puzzle, as well as our 3 weeks in Asia. This is third inning, top of the third, one out of this AI game, and that's why I just think names like NVIDIA, days like today, you buy names like Oracle, Microsoft, NVIDIA, because I believe this tech bull market has another 2 years left.
I mean, as a baseball numbers guy, we now know sometimes the third inning is your high leverage inning, where you got to kind of bring in the best arms and try to put down a threat. And I'm wondering right now if NVIDIA's numbers, and I've been kind of puzzling over this all day, as great as they are and as much confidence as Jensen has about the next 4 or 5 quarters, you wonder if everybody can have equal confidence in the customers that are giving him all that money and allowing him to earn those margins on their spend, and when they're going to sort of get clarity about the payback.
Look, it's a great point, but I would just say, look, in the U.S., 3% of companies have gone down the AI path. Europe, 0. You look at, in Asia, ex-China, minimal, less than 1%. Sovereigns, Middle East, just starting. I mean, my whole point is that, right now, demand to supply is 12-1 for NVIDIA chips. And of course, AMD and others are going to play. But the reality is that we are still early. I mean, you're talking more money is going to be spent in the next 2 to 3 years than the last 8-10 years combined. So I get some of the worries, but I believe the bears will continue to watch this AI party from the outside looking in as they continue to prove it out. And I think Street's underestimating numbers anywhere from 15 to 20%.
Right.
Next to 12
but is that
months.
not the bull case for NVIDIA and the whole food chain for the infrastructure build out? Can it not also be the bear case for the Metas of the world and the Microsofts that feel like they're on this unending treadmill of having to spend, hoping that they get the return?
Yeah, and I do think it's a little more than hope, because the reality is that the use cases, if you almost put the pieces together, look at Palantir, look at MongoDB, look at Snowflake. So you see the use cases are exploding. Look, and it's an arms race that they are having to continue to spend on, and you're going to see the same in the Oracle. But I think Meta, we look out 12 to 18 months. This was a table pounder moment, just like we saw with Alphabet as a table pounder.
Well, I was going to get to Alphabet because that's a really fascinating situation, how it's gotten revalued higher, tremendous amount of sponsorship all of a sudden of this name that people really had a lot of skepticism about not that long ago. Now, their new model is getting that people really, I guess, in terms of its performance, the new Gemini. And also, they did it, kind of with their own processor. So how does that play into the whole, NVIDIA at the center of this question?
Sure. Well, NVIDIA obviously fueling it centerpiece in terms of one chip in the world, but the reality is Alphabet, you go back 6-8 months ago, New York City cab drivers bearish on it, right? So it's one AI that is ultimately going to destruct the model. The opposites happen. I mean, I think now you see Sundar and what's happening at Google, they're on the offensive. I mean, you look at what they've done with Gemini, this is just the start, because the reality is in Cupertino for Apple, who are they going in for AI? It's just a matter of time until they do the Google Gemini deal as well.
Yeah.
So that's why you've seen that stock at continue re-rating, bull case $400. My colleague Scott Devin and I, we've done a lot of work. Look, I believe this is one. This is a name you continue to own, just still early days.
And then when it comes to Apple, because you mentioned it's an ARM.
So far, I agree with everything Ives has said. And I think a lot of people will remember that I was saying my fair value for Alphabet was $290 over the summer, and we got back to it. So we'll see what happens. But I do think Alphabet's in a great position going forward.
Arms race, well, they're not really participating, at least in terms of the gross dollars being funneled in that direction.
Yeah, I think I think now it comes down to, like, obviously iPhone 17's been almost a sleeper upgrade cycle, but you have the biggest install base in the world. Monetization is right now on the verge. 2.4 billion iOS devices, 1.5 billion iPhones. The consumer AI revolution will go through Apple and Cook, but it all comes down to Gemini. And now that DOJ that has cleared, that gives them the opportunity to walk down the aisle and ultimately ink that partnership. We said that's worth $75 to $100 for Apple stock. That's why I continue to view that as just a must-own name here.
All right. I am going to disagree with something that I've said. And I respect Dan Ives. Where the hell is that coming from? Sorry, everyone. Sometimes that happens. That was the next video. It just went into autoplay. So I would have rather Apple built out its own AI engine rather than tap Gemini. The reason being is what made Apple so great is they've owned the entire ecosystem for their operating system. Everything is moved flawlessly. I don't like the fact that they're going to have to be dependent on Gemini now. And what happens after the initial deal? So let's say they do a 3-year deal for this. They're going to be so dependent on that renewal. Alphabet can come in and jack up the price 50% or 100%. And there's really nothing that Apple can do because now everything is already built on it. That engine is already built. So I'm annoyed that Apple missed the boat. And I think this is super bullish for Alphabet, not for Apple. But I do believe that on a consumer facing level, the two biggest beneficiaries will be Apple and Alphabet because they own the cell phone industry and the tablet industry. It's just who's going to come out on top. I think it's Alphabet, even though I hate the Android system. I just think that they're so far ahead in the game that it's going to allow them to do things that they may not add into the Apple ecosystem. We'll see. We still have a lot of time for that to come out, but I think it was a mistake that Apple didn't take AI as seriously as these other companies. But I happen to agree with Dan Ives, and a lot of people don't take what he says seriously because he's not necessarily a valuation person. He looks more big picture and he looks at what's going on in the global markets because he travels to all the global markets and he does boots on the ground research. You won't see him talking about a free cash flow multiple or those types of things. But from a big picture, there's none better. And I really agree with just about everything he said, except for how much Apple's going to benefit on the stock price. I think Apple's in a position where I don't see the growth in the future. We'll see. Hopefully I change my mind because I'm still an Apple shareholder and I used to be very bullish. I'd like to become bullish on them again. So let's say Tim Seymour. He's a guy that hasn't just started coming back to CNBC. I actually think Tim is really smart. And this video is markets still have concerns around circular AI investments. And that's one of the narratives that has been going around on X quite a bit. So let's see what he has to say, and then I'll let you know what I think about this.
And a CNBC contributor.
Hey, Contessa.
Help me make sense of these wild moves.
Well, not for the faint of heart. I still think there's a question about tech valuations, although NVIDIA's valuation doesn't really bother me. But and you've moved with a couple of the other, call them Mag 7s, as we do, where value is kind of interesting again if you're looking at Meta and whatnot. I just think there's this confluence of we still don't know what we're paying for and what it's going to deliver now as opposed to out there. I still think there is some sense of concern around circular investments. And even though for NVIDIA as being a, call it an infrastructure story, an AI infrastructure story on top of its core business, I think it's probably worked for NVIDIA. I think for the rest of the market, it's they kind of gave you what they told. We had a chance for the analyst community to dissect and think about that. Certainly the buy side probably expected what they told us yesterday. And I think you get a little bit of that sell-off.
When I'm looking at the S&P 500 here, the laggard is Robinhood. It's off by more than 7%, but you've got Interactive Brokers down more than 2%. On the other hand, Walmart is leading the S&P as the gainer with 5.8%, that stock higher by 5.8%. Let's talk a little bit about Walmart and what it means to have this really blockbuster earnings report amid quarter after quarter of comp improvement.
And just before we get to Walmart, that's the whole point. I mean, Robinhood and some of the digital economy, those aren't strong halves. And I talk about in terms of the investor group. And so bring it back over to Walmart and where we are with a story that's hardly cheap, right? If the market's worried about valuations, then they should be a little skittish on Walmart at 36 times forward. But
what have I been saying? Somebody that agrees with me. Hallelujah. I swear I didn't watch this. I did not watch this. Thank you, Tim Seymour.
There's a dynamic here that I think is best of both worlds. Walmart is giving you both that investment into technology and maybe AI, but more importantly, really where e-commerce and efficiencies have paid off. They've paid off in the gross margin, although the gross margin was a little weaker here. But I think category by category, we're seeing Walmart is taking market share. But Walmart, more importantly, seems to be more focused on profit than revenue. And I know that's crazy for the world's biggest retailer, but that's part of the story here. And I guess, you know, what's fascinating, maybe the more interesting part about the Walmart story, even though it's you know, the move from the New York Stock Exchange to the NASDAQ 100 is something that embodies and signifies where Walmart probably sees themselves as a company. It's also probably helps in terms of where you get follow through from an investor base that are tracking the NASDAQ 100. So fascinating that Walmart is flying in the face of a market that's concerned about valuations when Walmart's never been more expensive relative to itself and even relative to its peer group other than Costco.
Well, that makes it much more like a tech company route right now. Then is Walmart, do you think, a risky bet at these prices?
I think there's going to be the ability to sell off Walmart if we see the two pillars of the story here, which I mean on the demographic story of the consumer. So the lower income consumer and the higher income consumer and the broader merchandise mix. If we start to get any kind of a growth scare, I realize markets overall might be sniffing some of that out. And that's where you would see a lot of pain across markets. But I think until we start to see that, Walmart is very well positioned. Again, we talk about massive investments into technology and where logistics and ERP and what has been brick and mortar for them for a long time is now really, really paying off and showing the difference between them and almost everyone other than Costco. But I still think Walmart is eating into Costco.
Points. Let's bring in.
All right. So I would agree with a lot of what he said. I think Walmart is eating into Costco. I do think Walmart is expensive, but at the same time, is Walmart trading where it should be trading and technology is just getting hit? Should technology be trading higher? That's really the question. Walmart's a phenomenal company. They're going to be here most likely in 25 or 50 years from now. They'll most likely continue growing the dividend. And you can't replicate what Walmart has accomplished and what they're doing. But at the same time, they don't have a full-blown cloud division like AWS. So it's crazy to me that they have a bigger valuation on a multiple level than Amazon. But we'll see. I mean, it's nice to actually hear that I'm not completely freaking crazy on that idea. And I do want to get to some of these super chats. So first, thank you, G Money. OpenAI is trading at an infinite PE that affects all other AI companies. That's the bubble. Here's the thing. OpenAI shouldn't be a private company. They should be public at this point. And we talked about this the other day. I'm not going to go into the whole thing, but it's hard to make the argument that OpenAI should or should not be impacting it because we can't see their numbers. So it's not going into my analysis because I don't have their numbers. I'm not going to handicap something I can't pull the numbers from. All we know is that OpenAI is spending a lot. They're generating a lot of revenue. They say they're going to generate more revenue. I think they should be a public company. I mean, they're too big to be a private company. That's just my opinion. Calaxy, thank you. Thank you so much for the super chat. Look, I don't know if this is a buying opportunity or not today. I don't know if the market is going to keep going down or not. All I can tell you is that what I'm going to do. Every 2 weeks, I continue to buy the S&P 500. I have income sitting there, ready to be deployed. I want to see if the market slides tomorrow and Monday, or if we get a little bit of a retracement. If we get a retracement, back up, and this levels off, the stocks that I am personally buying myself, this is not for anybody else. This is just what I'm doing. Look, I don't take a lot of risk anymore. All right. I am still on the Amazon kick. I think Amazon is going to be a much bigger company in 4 years from now. And I like Amazon on dips. Amazon is likely to become the first $1 trillion company. I think that they can expand their margins. They have an 11.2% operating margin. I think they can get to 18 to 20% over the next couple of years through robotics and AI. If they do that, I think that they will have a much larger market cap because on $1 trillion on revenue, they could be at 180 to 200 billion operating income. So to me, that's one of my top things that I like going forward. I also think Meta is a really interesting valuation here. And I think the S&P is very interesting. I think NVIDIA is really freaking interesting also at these levels. NVIDIA's trade, like, keep in mind, everyone, less than 20 times forward earnings is where people used to think value companies traded. So it's hard for me to take this sell-off seriously when NVIDIA just put up 57 billion in revenue, which was 62% year-over-year growth and 22% quarter-over-quarter. I mean, net income of 31.9 billion, which was up 65% year-over-year. I think the profit margin was around 54-55%. I mean, that's absolutely insane. You had data center and AI and cloud revenue up 25% quarter-over-quarter and 66% year-over-year to 51.2 billion. There's just so much going on with them. The ramp in Blackwell is fully subscribed. They're just gross margin 73.4%. Hold on one sec. I'm gonna turn my ringer off. There's just so much that I like. And when you see the guidance, are they going to hit the guidance or not? I mean, 65 billion for Q4 plus or minus 2%. That's a huge increase. And if they can maintain these margins, you're going to be on a run rate of 125 billion of net income next year. So I like NVIDIA right here. I mean, I was buying NVIDIA around 165, 170. I'd have to go back and look, but I think my average is probably 115 to 118 area. And I think my last tranche is I got out of some commercial real estate and moved it into NVIDIA. I think it was around 165, 170 area. But look, I have a pretty full position on NVIDIA. I don't necessarily have a full position on Amazon the way that I do Meta and NVIDIA. So for me, I'm really looking at Amazon more, but if NVIDIA keeps sliding, I'll come and buy more NVIDIA. So can't tell you what to do, but those are the things I'm looking at. I'm not looking at any of the high flyers, although CoreWeave is something that was very interesting to me. I still don't understand their profitability model going forward. But if the neo clouds continue to sell off, I'm going to ask Sam to drill it into my head again and help me understand it, because I do think that after seeing all the CapEx deployment and all of the profitability that the hyperscalers are doing and the subscription to backlog, I do think that there could be a play in the neo clouds, but I'm not sure that they're done selling off yet. So I am keeping my eye on them, and I got to do more research on them. So I hope that I know that's correct. It's kind of weaving in and out, but I mean, can't tell you exactly what you should do. I'm not in your position. Tom Lee. Let's see what good old Tom Lee has to say. I mean, if some people are pissed at this guy, I'm down on BMNR and Ethereum. My thesis is still intact. Let's see what Mr. Lee is saying, and then I'll give you my thoughts on those.
Yes, now is Fundstrat's head of research, CNBC contributor Tom Lee, also the chairman of Bitmine Immersion Technologies, an Ether treasury company. All right, so Tom, you've heard what Steve had to say. This is, by the way, not unusual for NVIDIA, is it? NVIDIA, the good folks at Bespoke, your team, you've recognized that NVIDIA will often have these kind of wild swings following earnings, but what is your take right now on these markets?
Well, I think I'm going to kind of add to what Steve said. You know, I think the crypto market has been limping along since October 10th, because on that date was a negative shock. I mean, today's stock market looks a lot like an echo of what happened October 10th. But on October 10th, that liquidation was so big, Brian, it really crippled market makers. And our market makers are critical in crypto because they provide liquidity. I mean, they act almost as the central bank in crypto. And if they've got a hole in their balance sheet that they need to raise capital for, they need to reflexively reduce their balance sheet, reduce trading. And if prices fall, they've got to then do more selling. So I think that this drip that's been taking place for the last few weeks in crypto reflects this market maker crippling. And so in 2022, it took 8 weeks for that to really get flushed out. We're only 6 weeks into it. So I kind of concur. I think crypto, Bitcoin and Ethereum are in some ways a leading indicator for equities because of that unwind and now this sort of limping and weakened liquidity.
Well, that was the point that my very, very smart team behind me, we put together for the top of the show, which was showing that Bitcoin turned down today before the market did. All right, take us back. So October 6th, I think it was October 6th or 7th, Bitcoin hit 125,000. Yeah, a couple days later, it was still around 120,000. Now, obviously, Bitcoin's at 86 and change. So what specifically occurred on or around October 10th that would lead us to where we are now on what, November 20th?
Yeah. Well, Steve actually pointed this out. There's a lot of what they call automated processes in crypto. One of them is called ADL, okay, and that's an automatic liquidation feature that would take place if someone's account or their collateral drops in price. It's essentially like a margin call. On a specific exchange, a stable coin's price varied from other exchanges. It actually, stablecoin should stay at $1. It dropped to 65 cents. But that only happened within the exchange quotes, within this exchange because of liquidity. That triggered an ADL, an automatic liquidation across many accounts. It wiped out, as that spread across other exchanges, right? Because liquidations cascade. Almost 2 million crypto accounts got wiped out, even though minutes before they were actually profitable accounts.
So who is behind this? Like, who's the they in the market makers and they got hit? Who's the they?
Well, you know, Brian, I am aware of names, but because you know, I'm not someone who wants to name names. I think what you should keep in mind is that this error is actually essentially a bug, you know, a code error, because I think in retrospect they would have pulled pricing from across exchanges to set the price for that stablecoin rather than rely on internal quotes. But this has resulted in a lot of market makers and traders having less capital. And as you know, as crypto prices drift lower because trading volumes drop, they need to then have more capital available, which means they shrink their balance sheet further. So this is then that reflexive weakening.
I want to go back to this point, Tom. I hate the term glitch. I can't stand the term glitch because, you know, things go down at the airport and they say, well, a glitch caused your flight to not take off. That's not a glitch. That's more than a glitch. It's a word that is used to describe pretty serious automation issues, software problems, crashes, for some reason that they try to minimize. Is this some kind of a software bug that's causing part of this? I'm trying to follow exactly what you're hinting around about.
Yeah, I mean, Brian, it is. I mean, for instance, in 1987, portfolio insurance was the quote glitch, and that triggered the cascade in 1987. And so the industry learned and then never offered that again. You know, in 2009, it was really the collateral wasn't secure in real estate in these packaged subprime mortgages. Now, the industry learned and they recoded that. I'm talking about Wall Street, but then regulators came in and like overregulated. That was the negative effect of that. In crypto, this code of ADL and the way they pull prices is never going to happen again. The good news is we're not going to have overregulation in crypto, but now we have to deal with that liquidation effect. 2022 was a big liquidation, and it took 8 weeks. But that is not kind of, you're right. It is the nature of DeFi where there is going to be code and there's going to be an error found, and you said it, leverage is what's dangerous. And so investors should not be using excess leverage in crypto.
All right. I got a lot to say about this. This is going to be the last topic, I think. So I was on a midstream earlier, and just so everybody knows, Amit and I will be live at 9:30 tonight. And I do believe we have a problem with margin. I think, and this is my own personal opinion, okay? Keep this in mind. I think that there should be safeguards for people using margin. And when it comes to crypto, there are no balance sheets, there are no cash flow statements, and I couldn't tell you why they go up or down the way that they do. I started getting bullish on Ethereum over the summer with the Genius Act, because after reading through it, it made stablecoin adoption a real thing. We got a much different legislative environment for crypto, and the SEC would not be the governing body. Now, when I look at the companies that are building on Ethereum layer 2, it's MasterCard, Shopify, PayPal. We have the Clarity Act coming, and I think that we're really going to see true stablecoin adoption. Now, when that happens, who knows? But if you're on margin and you don't actually have the cash to back up that margin, you're playing a very dangerous game, because in events like what has happened in the past couple of weeks, you could very well get a margin call and not be able to back it up and have to liquidate your position into weakness, and that just drives prices down. And that could be what's happening here. Long term, I think Ethereum is going to be okay. Now, I am down on Ethereum. I am down on BMNR. But my 3 famous words of I don't care stays, because I originally went into this saying, I have no idea if if BMNR is going to go to 100 or 25. I have no freaking clue, but I'm going to scale my way in. Ethereum, I don't know if it's going to hit Tom Lee's price targets or if it's going to go down. I got no clue. And when I started buying around 3,700, it went up to 4,800, bounced around a little bit. Now it's down under 3,000. I have no freaking clue what it's going to do, but I do think long term, it will be higher than it is now. I think long term, it will be higher than it was at the 52-week highs. When that happens is anybody's guess. But goes back to my thing about being a long-term investor. If you're not in it for the long term and you're looking to make a quick flip, this can be very painful. And I think that younger investors that haven't been through big downturns or don't have a long-term mentality, this seems excruciating. But the last chart I want to bring up is SoFi, because I think, and Amit and I were talking about this, and I think it's a really good chart to look at, because it goes back to exactly my point. SoFi's had a hell of a year, and in a lot of these companies, let's start with Palantir real quick. So, sure, Palantir's down 25%, but when you go back a year, a lot of people were buying over here. Does it really matter? Palantir's still up 162% this year. So, if you're just looking at this for a 1 month or a 5 day, sure, it seems painful. But on a year-to-date basis, 105%, I don't know. That's not crazy to me. You know, Hood, same thing. On a 1 month, sure, it's in a freaking bear market at this point. But you go back year to date, you're up 185%. Is there really a lot to complain about? I don't think so. Now, SoFi, this is the exact idea about being a long-term investor. That's an ugly chart for most of it, because you had the initial pop after the IPO, got to around 25, fell to 15, got another spike to over 20, fell to 14 again, got another spike to over 20, and then it just fell and fell and fell, and it stayed in single digits. Look how long it stayed in single digits for. It stayed in single digits from April of 2022, okay, until September 2024. Almost 2.5 years with only a blip where it popped after earnings and then retraced down. So what changed about SoFi during this period? It actually became a stronger company. They actually innovated and got away from student loans being the lion's share of their revenue and built out diversified products and became a much stronger company. Now, the market didn't reward it, but eventually it did. And it went up to 17 beginning of the year. And then during April, we got down to under $10 again. Was that period fun? Absolutely not. But in the end, it's a great company that is growing aggressively, scaling profitability and scaling margins and scaling their future prospects. So this is why I always say, got to have a long-term mindset and take the good with the bad. The Bears won today, okay? But if we look at the S&P, look at SPY, today's not a great day. It's not a great week. But think about this, 3% in 5 days. If you have 100 grand in SPY, you're down 3 grand. It's not the end of the world. Past month, it's not that bad. Year to date, you're still up over 11%. So, got to take it with a grain of salt. I think there's a big difference between being in high beta flyers that have valuations that don't make sense. And keep in mind, I'm a Palantir shareholder, and I've been saying they're overvalued. And people are like, well, why don't you sell? If I think it's going to be a bigger company in 10 years from now than today, why am I going to sell to have to pay taxes and then hope that I'm right and I can get it in at a better price and net everything out? I'm not going to take that risk. If I needed the capital, it's a different story. But there's no reason, if you have a long-term thesis, to play that game if it's in a taxable account. There's really no reason, because you have no idea if you're going to be right or not. But taking a step back, this is still a good year. We can still have an end-of-year rally. And I just think everybody needs to maybe not look at the accounts as much on a minute-by-minute basis and take accountability of the account. Do a health check. See what you're in. And maybe there's too much risk to one sector. I can tell you, I have too much exposure to tech, and I know I do. But I have made a decision personally that because of my allocations to an S&P 500 index fund and to my allocations to other ETFs, I am willing on the individual equity side to allocate toward tech more. Now, there is a question about what exactly is tech, because if you look, Amazon is not a technology company. They're considered consumer staples, I believe. You look at Meta and Alphabet, they're either considered, I believe they're considered communication companies, but I consider them tech companies. Now, I'm going to leave you with this. Amit and I are going to be back at 9:30, and I'm going to leave everybody with this. Today, the Bears won. I think this was overdone. I think NVIDIA crushed it. I think NVIDIA put up the best quarter I've ever seen from a company. I am very bullish NVIDIA. I am bullish the market long term, and I am not letting today get me down. And we'll see what happens tomorrow. We'll see what happens next week. And got one of the greatest holidays next week, Thanksgiving. Gonna eat a lot of turkey and a lot of pie. Enjoy. And let's see what happens tomorrow. But I'm going to sign off. Appreciate everybody being here. Actually, before I do, I didn't see these other two supers. Galaxy, thank you. So NVIDIA is obviously performing. How much of future earnings is priced in your opinion? Also, how low do you guess BMR is going? Look, I don't think there's a tremendous amount of future earnings priced into NVIDIA. I mean, it's still trading at less than 20 times forward. Now, if the analyst community is correct with where they are with NVIDIA, then I'll bring it up on the screen. So we got 36 analysts saying $9.47. And I say 2027 because, once again, their fiscal year ends in January. So when it says 2028 here, 90% of that or 95% of that is 2027. So I call that 2027. There's a lot of growth here. I think that NVIDIA is undervalued by quite a bit if these numbers hold up. And it looks like they're going to hold up considering that what Jensen said last night. So I do think NVIDIA is undervalued. I really do. And when you look at where, I mean, it's a numbers game, right? In 2027, you got 44 analysts saying they're going to do $395 billion in revenue. We know the margin has been hovering between 53 and 55% on net income. Call it $400 billion to make the math easy. At a 50% margin is $200 billion net income. No company's done that ever. So I think NVIDIA is undervalued here, and I think the buybacks are going to get massive next year. So I really wouldn't get crazy about it. And BMNR, look, it would suck if it goes lower. It would suck for me, and it would suck for a lot of people. But I mean, you have to be ready for it to go to 20 or break 20. Now, I don't know if it's going to do that. I hope it doesn't do that. But it could very easily go to 20, just as well as going to 35. I don't have a crystal ball. But be ready for either scenario. And then thank you again. Really appreciate it. Do you think we get 3 rate cuts, 26 with Trump appointee? I mean, look, we will talk about this at 9:30 with Amit. My personal opinion, it's going to be Waller or Bowman. They're going to be super doves. They're going to align with President Trump. I want personally rates at 2.5%. I made my position very clear many times. I am worried that the Fed is not going to cut in December and that they're going to play chicken and get behind, because the most important thing to me is the labor market. And I do think that with the Trump appointee coming in May, and then the schedule being June, July, September, November, December for Fed meetings next year, I do think we get at least 3 rate cuts next year. And I do think we're going to have a more dovish Fed next year. And the Fed needs to be looking at, with all of the unemployment happening, being at the highest level in years, a lot of productivity gains from AI and robotics, the only way to grow ourselves out of that and make sure we have enough good jobs for Americans is to make sure that we have a rate where borrowing is not too exclusive. You want to be able to borrow at 3.5% to 4%. That way, it incentivizes small businesses to grow, entrepreneurships to take a chance on a business, because that creates jobs. And keep in mind, with where rates are now, you have credit card interest rates at 18 to 24% on a lot of credit cards. I do think that that's a problem. I think it's a problem because that doesn't hurt the ultra rich. That hurts your everyday person that carries a balance. Not to mention having mortgage rates at 6.2 to 7.2% versus 3.2 to 3.5% is very restrictive. That extra capital on a $500,000 mortgage, as we saw earlier, is around $900 a month. That's a lot of bills. That's a lot of extra capital throughout the year. So we got to get rates down. Got to get rates down. Got to make sure energy stays where it is. Got to get natural gas down. I think we need to produce more energy. The super majors are positioned to produce more without really impacting profitability too much. And we got to make sure that we get this economy going for everybody. And it starts with the Fed getting rates down to under 3%. So long-winded answer, but yes, I think we get 3 rate cuts in 26. And Rusty, thank you so much for gifting a membership. Really appreciate it. I'm going to sign off. We'll see you everybody in an hour and 10 minutes. Amir and I will be live. See you soon.